October 19, 1987. The Dow Jones Industrial Average dropped 22.6% in a single day. It is the largest single-day percentage drop in stock market history. Investors panicked. People sold everything. 2 years later, the market had fully recovered and was hitting new highs. 2000, the dot-com crash. Nasdaq dropped 78%. Peak to trough. 2008, the financial crisis. S&P 500 down 57%. 2020, COVID. S&P 500 down 34% in 23 days. The fastest crash in history. Every single one of those events was followed by full recovery and new all-time highs. Every single one. So why does a market drop feel like catastrophe? And why mathematically should it feel like an opportunity? Let me show you the math that changes how you see market drops permanently. You invest $500 per month, automatically, every month. The market has two scenarios. Scenario A, the market goes up every month. After 12 months, you've invested $6,000. Your average cost per share is high. You own fewer shares. Scenario B, the market drops 30% in month 3 and stays low for 6 months before recovering. After 12 months, you've still invested $6,000. But during those 6 low months, your $500 bought significantly more shares at discount prices. When the market recovered, you owned more shares than in scenario A. The investor who kept buying through the crash ends up wealthier than the investor who bought only during the rise. Because the crash was a sale. When clothes go on sale, you don't sell the clothes you already own. You buy more. When the stock market goes on sale, every instinct tells you to sell. That instinct is expensive. Dalbar Incorporated conducts an annual study called the Quantitative Analysis of Investor Behavior. It consistently finds that the average investor dramatically underperforms the market, not because they pick bad stocks, but because they sell at the wrong time. In 2020, investors who sold at the COVID bottom in March and didn't re-enter until July, 3 months later, missed 45% of the recovery. That is not a small rounding error. That is the difference between financial independence and staying in the workforce an additional decade. Let me make this concrete with actual numbers. 2 investors. Both invest $500 per month in an S&P 500 index fund. Investor A starts in January. The market cooperates. It goes up 1% per month for a full year. After 12 months, they've invested $6,000. Their total portfolio value, roughly $6,400, a solid 6.7% gain. Investor B starts the same month. In March, month 3, the market drops 30%. It stays down for 5 months. Then it recovers. By December, it is back to exactly where it started in January. Investor A's portfolio, $6,400. A gain of about 6.7%. Investor B's portfolio, $6,650. A gain of over 10%. Investor B came out ahead despite experiencing a 30% crash because every month during the downturn, they were buying shares at a 20 to 30% discount. More shares. Lower average cost. Higher eventual gain when the market recovered. This is not theory. This is arithmetic. The crash did not hurt Investor B. The crash helped them because they kept buying. The investor who pauses contributions during a crash, "I'll wait until things stabilize," misses the exact months where every dollar buys the most. They resume buying after the recovery, when prices are high again. They turn the crash from an opportunity into a loss. Here are the 3 rules I give every investor in every market condition. Rule 1: never look at your portfolio during a news cycle about market crashes. Not daily. Not weekly. Monthly review maximum. Dalbar's research shows that investors who check portfolio value daily underperform quarterly checkers by 3% per year. Exposure to the emotional swings drives bad decisions. Rule 2. Set a written investment policy statement. Decide in advance, in writing, I invest $X on the XTH of every month, no matter what. When it is written, you have to actively decide to break the rule. That friction prevents emotional decisions. Rule 3. When everyone around you is panicking, treat it as a signal not to sell, but to confirm you're still buying. Market bottoms occur when fear is at maximum. If headlines are catastrophic, the sale is probably near its peak. Every single market downturn in history follows the same emotional cycle. Understanding it in advance is the difference between participating in a crash and profiting from it. Phase 1. The market is rising. Headlines are positive. Investors feel optimistic, then excited, then near the peak, euphoric. This is where most retail investors buy in near the top because everything looks good. Phase 2. The market starts dropping. First comes anxiety, that unsettled feeling when the portfolio is down 5%. Then denial, this is just a correction. Then fear at -15%. Then panic at -25 to 30%. Then full capitulation, where investors sell everything just to make the pain stop. Capitulation is the bottom. It is the moment of maximum pain and maximum opportunity simultaneously. Phase 3. Recovery. It starts quietly. Most investors who sold do not buy back in immediately because the news is still bad and they are psychologically exhausted. The market recovers while they wait for a sign it is safe. By the time it feels safe again, the recovery is mostly over. The average investor who sold at the 2020 COVID bottom and waited for confirmation before re-entering missed approximately 60% of the recovery in the first 6 months. Understanding this cycle does not make you immune to it emotionally. But it does give you a framework. When you feel the urge to sell, check where you are in the cycle. If fear and panic are high, you are likely near the bottom of a sale, not the beginning of a permanent decline. Warren Buffett is often quoted but rarely understood. People quote him saying, "Be greedy," when others are fearful. But they do not act on it because they assume it requires insight they don't have. It doesn't. Buffett's actual strategy during market crashes: he does nothing differently. He buys consistently. He ignores headlines. And he has said explicitly, in multiple shareholder letters, that he would put 90% of his estate into a low-cost S&P 500 index fund and 10% in short-term bonds. Not individual stocks. An index fund. For his own family. If the most successful investor in history's advice for his own family is to buy an index fund and hold it, what does that tell you about how complex this actually needs to be? The people who built wealth through 1987, 2000, 2008, and 2020 did not have better information. They did not time anything perfectly. They just kept buying. Through the fear. Through the headlines. Through the certainty that this time was different. It wasn't. It never is. The next market crash will feel exactly as catastrophic as every previous one. The recovery will feel exactly as impossible until it happens. Your only job is to keep buying and not watch the news. Word count: 1 400 duration, 10-minute end card, V11 index fund lie.